Uh, Welcome back, friends. Since long I have not uploaded any video for the FRM course material, but I will promise that this video lectures will be continued without any much interruptions from today onwards. So last I remember I was discussing about the types of risk, which is a course content of FRM level 1, foundation of risk management. So we already discussed the types of risk, that is market risk, that I already covered in my last video, and I touched upon little bit about the credit risk. In credit risk, I already explained the two major component, that is settlement risk, and in settlement risk I already explained the pre-settlement risk and settlement risk. As far as the quantum of risk is contained in we have already seen this pre-settlement risk. The amount of the risk that an organization carries is limited up to the price movement of the particular contract, and in settlement risk the amount involved is the total amount of whatever the contract is existing between the two counterparts. In credit risk we have some more segment, like settlement risk we have already discussed. Then we have default risk, we have downgrade risk, we have bankruptcy, so these are the predominantly the risk that can be linked to the credit risk of a counterpart. Settlement risk I already explained. About the default risk, as the name suggests, when there is a total default by a counterpart on its contractual obligations, that may lead to a default risk. Suppose there is a contract between party A and B, where they will supply some goods to B, or maybe some financial assets like bond, or maybe some forex on exchange, or maybe some CPs or CDs to the party B, and party B will, or maybe a loan to party B, and party B will repay this loan on a bullet basis, or maybe on amortization basis, or pay the price of this bond, or maybe the obligations under the foreign exchange transactions. When the party B not able to fulfill his obligations, this kind of risk is called a default risk, and the default risk carries the larger risk as far as the quantum of the amount per se, because here the amount of the risk involved is limited to the amount of the obligations they have undertaken. Downgrade risk is in the sense is related to the ratings, because in the financial market, when we make an investment, or we give a loan, or we invest in some kind of a organizations, we do a rating. Rating can be an external rating, or maybe an internal rating. So whenever some company enter into an credit transactions, so they see the ratings. External rating means a rating which is done by the outside agencies, like internationally there is a Moody, Fitch, or S&P, and in Indian per se the CRISIL is there, or maybe CARE. So these kind of rating agencies are there. Oh, sorry, these are all actually, sorry. These are international rating agencies, and domestics in India are CRISIL or CARE. These kind of rating agencies domestically rate the companies. So when we make an investment in any of these, any of the company or any of the organizations, we see that their ratings. If the rating is rating like rating tree like this, AAA, then A plus, A, triple B, double B, then B. There are certain other extension also available rating like double A plus or A plus or double B plus or like B plus or maybe B minus or double B minus. These kind of rating tree is available, and whenever we invest or do some kind of credit transactions, we see the rating of that particular company. If company is rated AAA, then the credit premium or risk premium is very less. Like because every transactions in credit there are two components, two primary component. One component of pricing of any instrument is the risk premium, and another is tenor premium. By these two components, the pricing is decided. If risk is high, then pricing will be high. When tenor is greater, then the price will be high. So if the company is rated A, it means the company is having a less risk perceptions from a rating agencies, then the pricing will goes down. And similarly when the tenor is high, the pricing goes up. When tenor is low, the pricing goes down. In what happened when we price, suppose it is a 5-year loan we are extending, and the company is rated A at the start of the loan. But as maybe after 2 years or maybe after 3 years, there were because of some external events or the internal events, the company's rating has downgraded to A. In that scenario, whatever the pricing we have given, depending on this rating of AAA, will not hold good because the company is rated A plus. So this will affect two way. One is that our risk has been increased of default. Another way, thing that will be added is the kind of the capital we have to provide. Because the capital adequacies depend on the rating of a company. When it is AAA, we have to provide less capital, and when the rating goes down the tree, we have to provide more capital. So that way, when the company is downgraded, we are affected by two parameters. One is the pricing is not suitable because we price the company depend on rating of AAA, and the amount of the capital we need to provide to continue this loan, that will be increased. So that way, that kind of the event may lead to some kind of a credit risk. Now we will discuss about the bankruptcy risk. Bankruptcy risk name suggests when a company is totally gone bankrupt, then whatever the obligations the company is having towards us, they will not able to pay back. So then in that case we have the credit risk. So these are the broader credit risk can say scenarios. Now we will discuss the next risk, that is operation risk. already discussed. Market risk, credit risk. Now next is operational risk. The operational risk is the risk event which emanates from the controls and the internal systems of within organizations. These are totally risk which is limited to the company itself. It is not related to any kind of a market or any of the event which is not control of the company. So operational risks are totally is manageable or is emanates from the organization itself. It can be like IT. Suppose the company is having the systems which is very not robust, and some of the its own employees or maybe some of the somebody outside from the company uses their IT systems and do some kind of a fraud or some kind of event, maybe to some kind of risk. So this then it can be a legal risk also. The company, when they are doing some kind of a transactions, they are not properly documenting that kind of a contract, they are not taking the legal opinion properly. So in case of some kind of a default or some kind of a dispute, their documents is not able to support the company's rights. So then this kind of a risk is called the operational risk. It can be a reputation risk also, is part of the operational risk. So these kind of risk are called operational risk, which is emanates from the people within organizations, maybe their IT systems, maybe their operations, robustness. So all this kind of events is called operational risk. Now fourth is liquidity risk. Liquidity risk again can be having two broader categories. One is a funding liquidity risk. Another is market liquidity risk. Funding liquidity risk means the as a company or maybe some financial institutions, they have various mismatches in their asset liabilities, because as a bank, if we say bank's major role is to do the maturity transformations, where they take short-term kind of liabilities and they fund long-term assets to get a better yield or get some profits. But in the scenarios where they are not able to get the liability from them, and there is a mismatches, and those mismatches is not this organization is able to meet. So then in that case the liquidity crisis comes, and this kind of risk is called the funding liquidity risk, like which happened in 2009 financial crisis, when the big investment firms in the US having the large ALM mismatches. They were borrowing very short term and funding a long term assets. When the market is dried up, liquidity was not available in the market, they were not able to fulfill their obligations, and they gone for the bankruptcy or maybe taken over from the other firm, or maybe they are given they were nationalized. They were government has bought those entities to run the show. Now next is the market liquidity risk. Market liquidity risk means when you have some assets which you are not able to dispose of in the market because of the various reasons. The market is not very liquid for that particular assets. Like you have some kind of a real estate assets, and the generally real estate assets, when you try to liquidate, it takes little bit of more time, because there are a lot of other risks involved in the real estate, like legal risk, or maybe the end users are not there in the market, and there is a economy is down, going towards recessions, in that scenario, sometimes you are not able to liquidate your assets, or maybe you are liquidating your assets, but the market is giving you the price which is very low, and which is said huge discount you have to sell your assets. On those scenarios, you will get some kind of a very large losses in your transactions. So those risks is called market liquidity risk. So friend, for the today I will close this lecture, and I promise that whatever the balance of FRM is part 1 is there, I will cover as soon as possible, and these videos will be available on daily, or maybe 2 days or 3 days gap only maximum, and I will try to cover the maximum syllabus, maybe 2 months. So that is my target. Thanks for watching. If you like the video, please like it and just subscribe my channel so that I can be motivated to post more videos on regular intervals. Thanks for watching. Bye bye.